Good morning, everybody. Duncan Clubb from BDO in Sydney here. Welcome to this, the fifth webinar in our current series on restructuring and insolvency. This is one on tax and tax issues and insolvency. We've got about 40 odd people on the line at the moment. We'll just give it a few more minutes for, I guess, some of the stragglers to join, and then we'll kick off. Thank you. So just bear with us for a couple more minutes. All right, well, look, I think we might start. Thank you all for joining us. I'd just like to introduce Fady Abi Abdallah from BDO Tax in Sydney and Marcus Leonard from BDO Tax in Sydney, together with Alastair Raphael from our restructuring team up in Brisbane. The purpose for today's session was really to give everybody a little bit of insight into the tricks and traps associated with tax as it relates to restructuring. It's an area that no one's expected to be a specialist on, other than Marcus and Fady, obviously, but it pops up on pretty much every engagement that we're involved in, and we find it particularly beneficial having these guys in the building with us, that we can call them up and ask them questions, and it happens on, as I said, pretty much every engagement. So basically today's session, just to get everybody up to speed and aware of some of the issues that we face as we're considering restructuring engagements and delivering on restructuring engagements. So that you can think about that when you're planning out your recovery actions, and it doesn't pop up and blindside you really. We'll be dealing with director liability for tax. We'll be dealing with GST and indirect tax, and we'll be dealing with direct taxes such as capital gains. So on that note, I'd just like to pass over to Fady and Marcus to kick things off. If you have any questions, just type them in the chat box, same as our previous sessions, and we can address them either at the end or as the session is going on. All right, thanks, fellas.
Thanks, mate.
Thanks, Duncan. So look, I'll start off. It's Marcus here, and I'm going to cover the income tax issues. And following that, my colleague Fady will cover the GST and indirect issues. So look, one of the things I thought I'd start off with is, just as a generalisation, is when you take over what I call a distressed asset, and I'm going to use property as my main example because that seems to be the one asset that gets disposed of that triggers a number of unintended consequences for tax or issues that should be considered. And I guess starting out, the real important part to understand is when you take over a distressed asset such as property, the way you plan to sell that asset or dispose of it will have an impact on the after cash that you can distribute back to the creditors. And tax plays a big part in that, because the way you sell it will impact what tax you need to withhold and remit to the tax office. And what I'm going to do is I'm going to go through that. You may not what we call as mortgage in possession, where you take over an asset and try to not be in a situation where you need to remit tax to the tax office, but that doesn't always work, and you need to be very careful when you go down that path. So let's just start with property. And one of the reasons why I use property, and I'm going to go through a real life example, is when you take over a group, this is when you can get some nuances on the tax outcome. And the example I'm going to give was a group that did get into a scenario where receivers were appointed. And the main reason the receivers were appointed and tax became a big issue is there was a number of entities in this group. And what this group had was what I call, the key property asset. that it started off with. It was quite valuable. They'd held it for a number of years. But what this property was used for was really security for other ventures that did not go too well. So when the receivers went to wind up this group and start divesting all the assets, when they came to the original entity, the tax outcome was quite significant and needed to be looked at more detail. So as a starting point, if you're selling a capital asset such as property, you do need to do a bit of historic review on when was the asset acquired, how much was it acquired for, and how much are you about to sell it for. And rule of thumb, if you're going to sell it for something more than you paid for, then there's going to be a tax liability for that gain. And generally, if you're at a company level, you're going to be looking at about 30% tax rate. Now, cost base of property, also you need to be careful. If it's a commercial property and they've claimed things as capital works deductions or depreciation, you do need to take that off the cost base of what was paid for it. So that could actually reduce the tax base you get when you work out your capital gain. The other thing to be mindful of is you do need to look at whether the group has any prior year revenue or capital losses. Remember, that is an entity by entity scenario. So you can have scenarios where losses are in other entities, but may not be in the entity you're selling the asset from. And unfortunately, in this current tax regime, you can't transfer losses or offset them if the group is not tax consolidated. It also, another thing to be mindful of is the timing of the sale for tax purposes. It is based on the contract date, not the settlement date. And that may be really important when you enter that contract if you need to undertake, and I'll go through my example, certain steps to reduce the tax exposure. Now, you would have heard a lot that a capital gains tax you get from selling property can be reduced what's called a 50% CGT discount. Please note this does not apply to companies, and you do need the discount or the capital gain distributed to an individual to get it, or a trust. In a scenario of distressed assets, it's highly unlikely any profits would be distributed to the stakeholders, as you're basically divesting the assets to pay the creditors. So the CGT discount would most likely not apply. So let's go through a case study, because I think this always works to understand all the trips and traps you should think about. So we had a scenario where receivers and managers were appointed over ABC. Now, ABC owned 3 properties. Now, these 3 properties were in different entities, and there was what I call the jewel in the crown, which was a significant property that had appreciated in significant value, but unfortunately was used as basic security and this entity loans for other entities that faced, uncertain times and basically went into receivership. So the issue the receivers had when they took over and they started to divest the assets, the ABC entity had a substantial tax liability due to the large, significant unrealised capital gain from one of the properties, which I said was the jewel in the crown. So just to give a bit of background, so what they did is they purchased this property in 2008. They'd had some prior year capital works deduction over the years of $3 million have been claimed, and depreciation in there as well. So the reduced cost base gets reduced not from the 10.3 what they paid, but you've got to take 7.3. When they went to exchange, the value of this was 25 million. So you can actually see there's a significant difference between the price or sale of the property and what the actual tax cost base is. Now, they were looking to do a mortgage in possession. However, there were some commercial and legal issues with that. So we looked at, well, could we actually dispose of this asset, sell it, and basically reduce that tax exposure? Now, if I take my capital proceeds of 25 million, I only have a cost base of 7.3. Prima facie, there's a $17.8 million capital gain, and there's $5.3 million payable to the tax office, which was a reduction significantly that would go out to the creditors in divesting this asset. So one of the things we did is, and this is really important, is to look at the profile of the group and see what steps could be made before we actually entered the contract. Now, the contract hadn't been entered before we looked at this, so we did have a bit of luxury to look at certain options to reduce that value. So one of the things is there were some prior year capital losses that we could look at to offset that. But one of the main things we looked at, as this entity was basically funding a lot of other entities, that basically the ventures and the developments did not go well, it had a lot of loans. And those loans, so what it was doing is it was getting funds using its asset and loaning it to related entities. That was an asset of this entity. Those loans were not going to be repaid. Those entities did not have the capacity to repay those loans because their debt to external financiers was actually greater than the value of the properties. So what we looked at, and we got the lawyers involved to help us, is we did a release of those loans. And the reason we did a release of those loans is when ABC no longer held that asset, it actually triggered a capital loss. And that capital loss of 8.65 million basically reduced our net capital gain. So we've gone from 17 million, we found some prior year capital losses for some other assets they disposed of that weren't good investments, and we decided to clean up the intergroup loans, which also gave us a tax benefit of $6 million. Now, noting the other entities may have tax issues for giving the loans of losing carry forward losses, but as they were not in a tax-paying position, losing carry forward losses for an entity that will never pay tax again was not a big issue. So now we're stuck with 6.35 million of taxable income. And we thought, well, what else could we look to reduce it? So one of the things is we started to reconstruct the tax returns for the last couple of years. And the last couple of years, due to a lot of expenditure and funding, there were actually sort of revenue losses, and they hadn't lodged returns for 2 years. So what we did is we got those returns up to date. We found there were some revenue losses that we could also use to basically reduce this profit. The other thing is we talked to the bank and asked them, you know, what outstanding costs or breaches under their loan have you not imposed? And one of the things you've got to be careful with financiers, if they're just trying to get their loan balance back, you need to go back to the terms of the loan to see if there's other things that should be charged under that agreement. What we found was they had breached a lot of their covenants. And one of the things is because they breached those covenants, they had a termination fee on swaps of $500,000. And also too, they had penalty interest of 2.2 million, which we then said to the bank, can you please charge that and add it to the company? And the reason for that is that would be a deductible expense that we could also use to reduce our gain. The other thing is we went back and looked at all the depreciation and capital works to see what deductions we could claim there as well for the year as well. And that was about $1 million. So what we ended up with after doing this exercise, we came from a $17 million prima facie profit, and now we actually had a carry forward loss of $250,000. As such, there's no tax to be paid. Therefore, when the asset was divested, the proceeds were received, there was all those funds to basically give to the creditors. There was no reason to go and do a Section 254 mortgage in possession, which, as I said, you can look at that as an avenue to basically give the creditors precedence over the proceeds as opposed to the tax office. But you do need to be careful whether that does apply. And I am aware that the tax office do look at those scenarios to check they're bona fide and they're not tax avoidant, as they also view themselves as a creditor and they put themselves at the front. One of the things is to also, I'd say, to look at, especially with groups, is a lot of entities, if they have performed well in historic years, is to check whether they've paid any tax instalments to the tax office. You may be able to get those refundable. You may look at whether they were payments that probably shouldn't have been made if they're insolvent at the time. But the other thing to look at, which is only come out recently following the COVID initiatives, is the government has introduced what's called a loss carryback provisions. And so what could happen is if you are in a scenario where you'd be in a loss situation, but you have paid tax in previous income years, you could actually go back and get a refund for that income tax. So the other thing I'd look at, even if you don't have a tax exposure, well, was the group profitable in the last few income years? And if so, you may be able to get that cash back from the government as a refund, thereby increasing the cash proceeds that can go to the creditors. So the outcome for the bank was the capital gain of 17 million basically got wiped to zero. The full 25 million, which was close to the market value of this jewel in the crown asset, went to the receivers and managers to give back to the creditors. And BDO was happy to help complete all the historic tax returns, reduce the tax liability, and consequently the bank did not need to go down a mortgage in possession scenario and be open to any tax avoidance attacked by the ATO by not withholding and remitting the capital gains tax. So as a take-home item, I think when you've taken over a distressed group, the key message I'd say is you need to understand the historic acquisition of all the key assets that you're about to dispose of, understand if there's any unrealised gains. If there are there certain steps you can do to reduce that tax exposure so you can get full cash to the creditors? And what's key, if you are going to do any planning, you must do it before you enter the contract to dispose of that asset. So as I said, to take home, review the cost base of the property, find out what they are, look at all avenues to see if there's any gains, losses, what are they, can you reduce it? Do think about being a receiver versus mortgage in possession. And also, it's really important to understand the timing of the sale. It's on the exchange of the contract, not the settlement. Now I'll hand over to Fady, who'll go through the indirect issues of GST, payroll tax and land tax. Thank you.
Thanks, Marcus. So I just wanted to run through very quickly the key indirect tax issues that representatives face when they're appointed on companies. The GST, payroll tax, land tax are the main ones. So from a GST perspective, the Act uses the term representative. It defines the receiver, manager, administrator, liquidator effectively as a representative, and the entity itself is referred to as the incapacitated entity. So broadly, what these provisions really try to do is they try to ensure that the outcomes for the entity are the same, regardless of whether the sale of that asset or the acquisition of the item was made by the representative or by the entity itself. So it does this effectively by shooting home a liability to the representative only in circumstances where the representative makes that supply within the scope of their responsibility for managing the affairs. So what that effectively means is if the representative makes an acquisition or makes a supply of something, land mainly, and the representative is the one who enters into the contract, then the representative is the person or the entity that would be liable to pay any GST that may arise in respect of that asset or sale. The key feature of these provisions is that they have this personal liability clause attached to them. So what that effectively means is if there is any GST shortfall on the sale of an asset, then the receiver or the administrator would be personally liable to the ATO to account for the GST in respect of that sale. And that's a really important thing for a lot of representatives, because what it does is it just creates this obligation to ensure that they've accounted for the GST correctly, and so that they can make sure that there's no exposures there later on. We've seen situations where even after the matter has come to an end, the tax office have come back to the relevant representative and sought to clarify the GST position on the sale of an asset. The other key feature of the provisions is that a mortgagee in possession, effectively they apply in the same sort of way. They try to also ensure that the liability is also there's also personal liability there by the person selling the asset, and that the implications are effectively the same regardless of whether the sale is made by the MIP or by the entity itself. So one of the key asset that we're often asked to look at as advisors in the GST space is land. As Marcus mentioned, it is the asset that most companies or most entities have, and that would cause a receiver to be appointed on. And there's a number of ways you could sell land, and conceptually land is subject to GST, but there are a number of different ways you could potentially reduce your GST liability. The common way is the margin scheme, which would apply to the sale of residential land. The other way is a sale of a going concern, and we've all seen them. I'm sure that effectively what we're doing there is take, for example, a commercial property. We're selling a commercial property with a lease intact, and the sale of that would not be subject to GST, assuming we satisfy certain requirements. And what these two schemes effectively allow us to do is it allows us this opportunity to review the GST position and not pay 10%, but rather pay 0 if it's a going concern, or some other number if it's sold under the margin scheme. A key feature of both of these schemes or both of these mechanisms is that we need an agreement in writing in place between the vendor, in this case would be the receiver or manager, and the customer and the purchaser. Now, it's a very simple requirement, but yet it's one that is often missed. So I'd be saying a key takeaway would be to make sure that we've got an agreement in writing, and that the lawyers are generally these days, the lawyers are across it, and they would have an agreement in writing there that documents the nature of the GST classification on the sale. Another key thing that we're seeing at the moment are creditors' trusts. Creditors' trusts and the ATO don't like them at the moment. They're really resisting paying out any credits on acquisitions made by the creditors' trust. So effectively, what they're saying is we need to look to see whether the creditors' trust is actually carrying on an enterprise, and the mere holding of cash on behalf of creditors isn't an activity that is in the course of carrying on an enterprise. And so what they say is that therefore doesn't give rise to a registration obligation, and as a result, there's no ability to claim back any credits on acquisitions made. So I think with that one, we need to just be mindful of some careful structuring, maybe before the creditors' trust is established. Have a look at all the acquisitions and make sure we allocate those acquisitions correctly between either the administrator period, the receiver period, or the creditors' trust period. I just want to give a quick case study on sale of a going concern of a property, and just to show how the provision works. So we were asked to assist ABC Proprietary Limited. The receivers were appointed over this asset. It was a commercial building, office space, and some parking down below. So at the time of appointment, the property was leased, and the lease was expiring in January 2021. And so the real issue was, how do we treat this from a GST perspective? It was a $10 million, this one was a $10 million transaction. The GST was $1 million, and the purchaser just refused to pay any more GST than, the purchaser refused to pay any more than the $10 million. So they said, if there is GST, then I'm only paying 10 million. If there isn't GST, I'm only paying 10 million. So if there is GST, the receiver had to effectively pay the GST from the proceeds. What that effectively does is it reduces the amount of the net proceeds remaining for the creditor. So the lease expired and the tenant was prepared to leave in January 21, so not long ago. And what we really tried to do was to ensure that the sale of this asset occurred pre-January 2021. So from a GST perspective, if the sale occurs within 1 day before the lease expires, the requirements are satisfied such that you will not have to pay any GST on the sale. If the sale occurs 1 day after the tenant leaves, then there's a different set of analysis that we would need to go through to work out whether a leasing enterprise is still being carried on. But thankfully, in this case, everyone was aware of what the issues were and ensured that the sale took place before the lease expired. And as a result, the receiver saved that $1 million. And just another quick case study on residential premises. It's very common, residential premises, where the banks provide funding for developments, and then some way along the line, the development or something goes wrong, and the bank is left carrying the development and holding the asset and pointing a receiver over it. So we had a scenario where we had two entities who were in partnership together. They built, I think it was 60 odd units, and once these units were completed, there was a dispute between the parties, and then the bank just called in the receivers, and the receivers were appointed. what happened with this, when we dug deep, we worked out that originally there was 2 parties on each title, but between the completion of the asset or the completion of the development and the appointment of the receiver, the property was partitioned so that 50% of the units went to one entity and 50% went to the other entity. So in our case, the receiver was appointed over one of the entities. So one of the key features of whether a property is new residential premises or not is whether it has previously been sold. So the receivers were appointed, and the receivers, the banks, were of the view that this was new residential premises because it hadn't previously been lived in. And once we actually got down to the detail, we realised that there was a partition. And what we argued was the partition was effectively a sale, and that as a result, what the receiver now holds is no longer new residential premises, and such that there's no GST liability on the subsequent sale. There was a lot of money involved with this particular one, and as I said earlier, the personal liability issues raised some concern with the receivers and the banks. So we went to the tax office and obtained a private ruling, and they ultimately agreed that there was no GST on the sale of most of those units. So that was a really big saving for the creditors and for the bank and the receivers. So I guess the real takeaway from that is it's always important to just work through the documents and the historical details to see how the property was acquired, what then happened with it, was it partitioned, was there a sale, and what potential GST opportunities exist to reduce the liability on the sale of the assets. Just some quick tips and traps from my end. I guess the main one is to ensure that a gross up clause always exists in all contracts. Just it provides that extra protection for a receiver and for the bank itself. So it's always important to do that. The other one, explore all avenues in respect to the GST, which is what I mentioned earlier about that partition one. So it took us a while to work out that the assets were partitioned, partly because the director wasn't helpful, which is something we find is very common in these sort of scenarios. But eventually we got to the bottom of it and worked out what we needed to do. The other key item on the tips and traps is that personal liability versus the creditor action. What we find often, the personal liability used to push receivers and representatives to take conservative positions. The difficulty with that is we've had some where they've been challenged by the creditors for not applying a proper GST analysis to the sale of the asset, such that resulted in the receiver having to pay more GST than they should have, because the receiver didn't want to take on that personal liability risk. So we found that creditors would often take action against the receivers or the bank for not ensuring that all potential avenues to reduce the GST liability was taken. So that's just a key one there, between the tension between the personal liability and the creditors action. Payroll tax. Look, I'll just quickly run through these ones. Payroll tax. We've got this concept of grouping of entities for payroll tax purposes, and what it effectively does is it means all entities in a group are jointly and severally liable for each other's debts. So what we find there is often you could have an appointment and not know that entity was previously not know that entity might be jointly and severally liable for payroll tax of another entity in the group. And a common example here is if you have a group of companies, one holds the asset, one carries on the trading enterprise, the receiver is appointed over the asset entity, and the trading entity goes into liquidation or administration, then the liability of the trading entity will effectively be an issue for the receiver that they have to deal with because of the joint several liability concerns there. So it's always important just to have a quick look and make sure that this is not something that can potentially reduce the amount of funds available for creditors. And the OSR, whilst at the moment they're not that active, they have in the past, prior to COVID, they were very active, and they're actually starting to bring back a lot of their recovery action. So they issue garnishee notices, compliance notices, and recover funds from third parties. So we all know what a garnishee notice is. That's the compliance notice is the state tax equivalent of a DPN, which we'll go through in a minute. And the one about a notice to collect funds from third parties is where they ultimately send a notice to recover some of the tax liability from the customers. And what we found is in the past, this can have an impact between the relationship between the customer and the bank. So it's always important that we kind of manage that process. Land tax, just quickly. So land tax is a tax it's actually quite important with this, given a lot of the receivers that are appointed over land or have land assets. So if you owned land in New South Wales, this is as at 31 December, then you effectively pay a land tax on the value of that land for that particular year. We have this concept of grouping of land and grouping of entities, where entities are commonly controlled. So what we find in this situation is if a receiver is appointed over a company, and that company has multiple parcels of land, let's just say it's a strata development unit block, and then there's outstanding land tax, the commissioner will insist on the payment of the land tax liability before issuing a clearance certificate to allow the receiver, in this case, to sell the land. So what we find is the OSR would generally try to recover the entire land tax liability, but if you engage with them and discuss with them and provide them enough comfort, they're prepared to allocate the land tax liability to the particular lot that the receiver is actually appointed on and that they're actually selling. And that's it from my end. Alastair, you want to take over?
Sure. All right. I guess from my side, I was talking about the director penalty notices, which I'm sure many people are already familiar with. And look, for those that aren't, effectively, it's the ATO's way of putting some pressure on directors. It's issued by the ATO when there's historically outstanding lodgements or significant debt. And normally the lodgements have to be outstanding for some time. 3 months is sort of the cutoff. And now with some of the recent changes, the suspected financing activity is also there as a reason for them to issue. And really it enables them to pursue directors personally for super, for PAYG, and in 2009 they extended it to GST as well, which can increase the size of the liability quite significantly. I guess it's key to note that when looking at the type of DPN, there's two key types. There's the lockdown and the non-lockdown notices. And I guess the important part is that really it comes down to, can a director get out of them for personal liability? And the problem with the lockdown notice is that they can't. And effectively, if your lodgements, which is the key difference between the two, are outstanding and outstanding for more than 3 months, even if that piece of paper hasn't been sent out to you, you've got a real exposure there. And so it's key for, I guess the key thing here really is that directors need to make sure that lodgements are not outstanding. The key thing is that if a director does get a non-lockdown notice, then they need to take action and take action within 21 days. And it's 21 days of the notice. So it's really important to make sure that address details and things like that are up to date, because they are very strict on the 21 days. And then if it is the non-lockdown, the only ways out are to pay the debt in full or to take action to put the company into a liquidation or administration. So quite limited once you get to that situation. But yeah, again, please make sure that it's the lodgement side that counts. The other thing really to be aware of this is that for new directors that come into a position of a directorship, then within 3 months, effectively they will be liable for debts that are outstanding for more than 3 months. So for new directors coming in, it's important to get across this very quickly to make sure that they're not going to be seen as not be made personally liable through historical liabilities for super, PAYG, and now GST. I guess really that's the extent of it. The takeaway is very simple. It's make sure your lodgements are up to date. It's make sure that if you're a new director, you properly understand the position of the lodgements, make sure you actually have a proper look and make sure there aren't outstanding lodgements, make sure there's no outstanding liabilities. The other flow through for having lodgements up to date is that under the newer regimes entered for the small business restructuring and the simplified liquidation regimes, there's a requirement in there to have your lodgements up to date, so there's an extra incentive to do so. We're not seeing a lot of activity out of those fields yet, but it's a possibility that that will be relevant to players. I guess the last comment to make about it is what we're seeing out of the ATO around their stance on appointments at the moment. And we're seeing that the ATO is still willing to enter into repayment plans with creditors. There seems to be a softer stance than normal. We're not seeing the winding up applications coming through. But what we are seeing is we're hearing of more times where there are the ATO is seeking further information from creditors or from companies to make sure that their lodgement information is correct. And so I guess what that leads to is this question mark as to how much longer will the soft stance continue. And there's sort of some signs that may change. It's just a case of when it will change, and I guess where the pressure comes from for it. And that's really it from my side. So that's the very quick take on director penalty notices and the ATO stance, unless the other guys have anything else to add.
No, look, thanks, Alastair. Yeah, just to sort of expand on that, I mean, traditionally the ATO has been a big driver of insolvency and restructuring. You know, typically on any given day there'd be 20, 25 winding up applications going through court from the ATO petitioning to wind up somebody for unpaid tax, and that really hasn't happened for the last 11 months. You know, how long it's going to continue for, who would know? But you know, it's going to remain an issue. That tax liability is only building. So at some point in time, the ATO is going to take steps to collect, and it's going to have implications for the wider economy. I guess to summarise, we haven't had any questions come through on the chat, so if anyone does have any questions, feel free to email them through after the session. I guess it's really just rammed home that good tax advice is invaluable in restructuring scenarios. It can have a material impact on the return available to creditors, and particularly secured creditors, having that right tax treatment there. So from my perspective as a liquidator or receiver, it's invaluable having Fady and Marcus in the building so that we can talk to them and make sure that we treat those assets and the tax treatment appropriately, because it's really to the benefit of creditors at the end of the day. So I'd just like to thank everybody for joining us. Fady, Marcus, do you have anything further to add?
I'm just going to add something in that might be relevant to the listeners and what's happening at the tax office generally with a lot of outstanding debts. As most people be aware, with COVID, the tax office has basically stepped back and haven't really been chasing a lot of outstanding liabilities. And I met with the legal firm recently that deal with a lot of repossessions and follow debts. And they basically were saying that the ATO has been putting out to tender for groups basically to look at these debts, but not only look at the debt, but look at the capacity they can apply them to assets to start getting payment. So as Duncan was said, the ATO hasn't done a lot, but they are getting ready outside of COVID-19 pandemic is to start looking at third parties to go and look at all these outstanding debts to see who are not meeting those obligations, especially payment plans, and then looking what assets there are and knowing how the ATO works. If there are significant assets, they will start to appoint receivers over those assets to get those debts paid, because their debts have blown out quite substantially. And I also got that from an assistant commissioner that they are looking at that. But politically, they just need to wait for the time being. I thought I just had that bit, what's happening in the market, Duncan.
Yeah, no, that's really good. Thank you, mate. Really good. All right. Well, look, I think on that note then, thank you all for joining us. We had no dropouts, so tax wasn't too boring. We've kept it short. So that's been brilliant. Thank you all for joining us, and hopefully you can join us at the next session, which will be on the 3rd of March, and is on priority claims in restructuring and insolvency, which is going to be particularly relevant given the way that FEG has been operating over the course of the last 12 to 24 months as they pay out employee entitlements. So yeah, we hope you can join us, and thank you all. Bye.
Thank you.
Thanks.
Thanks.